Hey everybody, I apologize for this unedited video. Usually I edit these more, but this just took place, so we need to talk about it. The major news, in my opinion, is not so much the interest rate policy from the Fed, but more so its projections, which it just updated. The Federal Reserve is now projecting only one interest rate change in 2024. Remember, in March, they projected 3 interest rate cuts. And if you watched my previous video, I did talk about how it was seemingly more and more difficult for them to fit 3 interest rate changes when there's only 5 Fed meetings left this year, including today's. And of those 5 meetings, at least 2, based on the CME Watch tool, there was absolutely not going to be an interest rate cut, which meant that it left 3 meetings for the Fed to cut 3 times. That we now know is most likely not going to happen. So let me give you all the highlights so you're aware of what just took place at the most recent meeting. So the first key point, obviously, is the Federal Reserve is holding their Fed funds rate steady. There will be no change in their interest rate policy this time around. Oh, we also need to talk about the CPI Inflation Report, which was just released right before this meeting, so we'll do that as well. The next main point is that the Fed, even though they're signaling just 1 interest rate cut this year, they say that there will most likely be aggressive interest rate cuts in 2025, with a total from now until then of 5 cuts. Now, that is slightly down from their projected 6 cuts earlier this year, but it is still relatively in line with their policy of getting the Fed funds rate quite lower by the end of 2025. These 5 cuts equate to a projection of about 1.25 points off the Fed funds rate, which, if everything goes well and according to plan, which is a whole nother discussion for a whole nother video, would leave the Fed funds rate at the end of 2025 at 4.1%. Remember, interest rates on mortgages, on credit cards, on car loans as well, are all based somewhat on this rate, especially mortgage rates. So if by the end of next year, the Fed funds rate is going to be 4.1% in a best case scenario, that means mortgage rates are going to be significantly higher. So we can expect 5-6% mortgage rates at least another year and a half out. So if you were waiting to buy a house, waiting for those interest rates to come down, it's looking like, again, they're going to remain higher for longer. And if you did programs like a 2-1 buy down where your interest rate was lower the first and second year, that is coming to an end, and a lot of those people are now going to have to pay the full mortgage rate. Remember, those programs were implemented a year or 2 ago with the expectation of mortgage rates coming down, with the expectation that the Federal Reserve's Fed fund rate would be lower by now, but it hasn't, and it looks like it's going to remain higher for longer. So again, that means interest rates on credit cards, on car loans, on mortgages are going to be high. So if you have debt that you can pay down, you should. Another projection was the long run interest rate. The Federal Open Market Committee signaled that they believe that the long run interest rate is higher than they had previously indicated. That projection for the long run rate of interest is now up from 2.6% to 2.8%. What this basically means is what I've been saying for quite some time, that we are going to be in a higher for longer environment when it comes to interest rates. Now, let's move over to inflation, both from what was said at the Federal Reserve's meeting, as well as what came out in the CPI report, which came out right before the meeting. So right now, the inflation report shows that it's basically flat, and it's sitting at 3.3% on the year. Remember, as I've said many times in many videos, inflation is proving sticky in that 3% range. And we've had multiple months and multiple CPI reports that shows that it is very sticky in that 3% range, and it's going to be difficult to get it under that 3% range and to the Federal Reserve's target rate of 2%. In fact, I'll even go out on a limb here and I'll say that I'm not quite certain that the Federal Reserve will ever achieve its 2% target rate. I think 2.5% might be more reasonable. And the core inflation rate, which the Federal Reserve cares about more, is sitting at 3.4% year over year. It rose 0.2% month over month. Remember, this excludes volatile energy and food prices, and the Federal Reserve, when it comes to making their policy decisions, cares more so about this number. 3.4% is still 1.5 points above the 2% target rate. And if you look at it in a percentage, it's like close to 100% higher, like 75% higher than what the Federal Reserve wants on a long-term basis, which is why we're now getting a single cut projection instead of 3 cuts for this year. Now, of course, the CPI inflation report was much more in depth. It covered shelter inflation, it covered services inflation, it covered food inflation, but I wanted to get this video to you with the key highlights as quickly as possible. Now, in the FOMC's summary, their projections for inflation this year actually did rise by 0.2% when compared to their projections in March. Their projections for inflation this year now sit at 2.6%, or 2.8% if you remove those volatile energy and food prices. So let's talk about the Fed funds rate, and then let me give you my thoughts on what all this means. The federal funds rate, as we said, remains unchanged, and it's targeted at 5.25 to 5.5%, as it has been for many months. Now, what does all this mean? It means that inflation is still well above the Federal Reserve's target rate, and it's proving sticky. It means that the Federal Reserve is going to have to hold its rates at the current level for longer, if not raise them, in order to get inflation to their 2% target rate. Now, in my opinion, I don't think they're going to raise rates. I think that if the worst case scenario happens, they're just going to keep holding rates at this level for much longer than anticipated. Could there be 0 rate cuts in 2024? Absolutely. We're already down to 1. From 3. That means if anything, absolutely anything goes wrong with the next CPI inflation report or the following CPI inflation report, there's a very real, non-zero chance that we get absolutely no interest rate cuts this year. I've said this in multiple videos. I probably sounded insane in March and April when I said that, look, this is just where we're at and that inflation is looking more sticky than it was expected. The market loves to be optimistic and they love to run with the good data. The fact of the matter, though, is that good data is not the only data that comes out. Sometimes bad data or just plain and simple terrible data comes out. And when you look at inflation, maybe it's not terrible this year, but when you compare it to the trajectory in 2023, this year has basically been a flat line. Inflation hasn't moved pretty much at all, and it's been stagnant in the 3% range, which means that the Federal Reserve is going to have to keep rates higher to fight this. So what do I think? I think that this is more in line with the reality, which is maybe one interest rate change this year, but at the same time, there is a very real chance that we get no interest rate cuts this year. Now, what about 2025? I think 2025, there's going to have to be interest rate cuts. I think by then, the labor market is going to start suffering, even though right now it is very strong. But when you actually dive into those numbers, the labor market numbers, there's a lot of part-time work and a lot less full-time work. So I think that these high interest rates are hitting the economy, and I think it's just a matter of time until more and more people are seeing the negative results of high interest rates. People already cannot afford homes. People are having to carry more debt on their credit cards in order to pay basic living expenses, and that debt now is costing much more than it ever has, even though obviously credit card interest rates are always high. Auto loans are high, and you've seen a lowering in demand in the car market, both new and used prices, and especially in the EV sector. So I think interest rates are absolutely slowing down the economy. The economy is just proving a little bit more robust and harder to slow down than anticipated. But again, like I've said in many videos, inflation is proving sticky in the 3% range, and that might be attributed to corporate greed. That might be attributed to the tons of money that were printed in the last few years. It might be a combination of those things. The point is, inflation is sticky in the 3% range, and it's going to remain so for a little bit longer. And this is just what has to happen. The Fed has to keep its rates higher. So again, I apologize for this completely unedited video. I just wanted to get this out to you guys as quickly as possible. If you like personal finance, world economics, you are in the right place. So I hope you stick around for the next video. I'm constantly sharing people's stories. I do that a lot on this channel. I share people's stories and I try to teach through storytelling so you guys learn valuable economic lessons. And of course, I always provide updates when I have an expertise to do so. I have a degree in finance, so that usually means world economics, policy changes, personal finance, etc. So if you like that stuff, you're in the right place, and I hope to see you in the next video. Take care.